S&P Global just posted a mixed Q2 2026. They beat top-line revenue estimates at $4.15 billion, which is up 11% year over year.
Right.
But they actually missed the EPS consensus, coming in at $4.08 adjusted.
And, immediately after that, management lowered their full-year adjusted EPS guidance to a range of $17.50 to $17.75.
Which triggered a super swift 5.2% pre-market drop in the stock.
Yeah, it's just brutal.
Right, so a solid top-line beat, but a really punishing sell-off for retail investors. I mean, how does that happen?
Well, to understand it, you really have to break down this segment performance. It is a really stark contrast.
Oh, totally.
You've got the heavy-hitting benchmark businesses just doing incredible work. Ratings surged 17%, and indices jumped 20%.
But then you look at the lagging segments.
Exactly. Market intelligence only went up 6%, and energy was practically flat, just up 3%.
Right. But here's the thing that stands out to me on the margins. Despite that EPS miss, SPGI achieved a 200 basis point expansion in their adjusted operating margin.
Yeah, hitting 54.3%.
Which is huge. So, look, to me, this feels like a top-heavy baseball lineup.
Okay, how so?
Well, your star hitters, ratings and indices, they're hitting home runs. But the bottom of the order, the energy segment, is just striking out.
That's a good way to frame it.
So if margins expanded by 200 basis points, why is the street penalizing them so harshly for this specific EPS miss?
Because it's a valuation trap. I mean, SPGI trades at incredibly stretched multiples.
Right. They're priced for absolute perfection.
Exactly. When you trade at that kind of premium, any lowered guidance triggers an immediate re-rating.
Yeah.
The market demands flawless execution across the board.
Which they didn't get.
No. And management knows this, which is why they really try to soften the blow by flexing their balance sheet.
Oh, yeah, the buybacks.
Right. They raised their 2026 share buyback target to over $7 billion.
That's massive. That's what, more than 5% of their entire market cap?
Yeah, it's essentially an attempt to buy back investor confidence.
Ah.
And they also touted a 5x surge in their Kensho AI API volume.
Trying to lean hard into that AI tech narrative.
Right, exactly, yeah. But throwing money at buybacks and highlighting AI adoption, it's kind of masking the core macro risks they flagged.
Which we should definitely touch on. And, just as a reminder for you listening, we're impartially reporting on the financial mechanics management outlined here, taking no sides.
Right. They specifically called out the geopolitical volatility stemming from the Iran conflict.
So how is that translating to the bottom line?
It's stalling renewals, particularly in that energy segment. The resulting volatility in the global markets means clients are hesitating.
Ah, so they're not necessarily canceling outright, but they're not rushing to renew either.
Right, they're just waiting to see what happens.
But I mean, if we zoom out from those smaller segment struggles, management also highlighted this massive cyclical tailwind coming up.
Oh, the maturity wall. Yeah, that's huge.
Right. $11 trillion in rated debt that needs refinancing over the next 4.5 years.
And every time that corporate debt gets refinanced, SPGI gets a cut to rate it. It's an automatic revenue pipeline.
Exactly. So here's a thought for you to consider as you parse through this report. Does this massive built-in cyclical tailwind make the current EPS miss just a temporary blip?
Or, on the flip side, will the rising internal costs of developing all their new AI erode the profitability of that future growth?
Right. Definitely something to keep an eye on. Thanks for tuning in, and be sure to follow the show for daily earnings coverage.